And so in a short-term time frame, sometimes fiat cash does make a lot of sense. I mean, it was one of the best performing assets last year, for example. If most things are going down a lot, then something that goes down a little bit, is flat nominally and goes down a little bit in purchasing power, as a section of a portfolio can be useful, right? If you have a specific framework that tells you, most things are not going to do well, we're say economically slowing, all these things are happening, then, an outsized position to cash or cash equivalents can make sense. Obviously, longer term, the story is very different because cash is programmed to lose value over a multi-year period, year in and year out. And so basically, if you're doing that, you're kind of just making donations. You're paying tribute to seniorage. And it's obviously worse in some countries than others. Basically, whatever you're holding, you're in some way strengthening that monetary network and you're enabling that monetary network. And so, if you say disagree with the actions of a specific government, if you're holding their cash, you're helping them. Kind of like if you're holding shares of a company, you're helping them. And then number two, you're getting slowly bled out. And a lot of people don't, there's just not a lot of financial literacy in schools and just in general, where they don't necessarily know the difference between nominal returns and inflation adjusted returns. And so they see a bank account and they see they're getting, X percent, yield back, maybe very little, but it's positive. And they say, well, at least I'm just growing slowly. And they might, of course, they usually know inflation exists, but they don't necessarily put two and two together and say, okay, what is the actual number that I'm losing in purchasing power per year? Assuming these inflation statistics are reasonably accurate, and then looking at my interest rate and saying, what am I actually losing every year? And if people did that, if rates were shown in inflation adjusted values, and it was just marketed as, hey, if you put your money in the bank account, you'll lose, 2 to 7% per year on average. And, but it won't go down, double digits, whatever the case may be, then it would be a lot less attractive to people. So I think some of it's literacy, some of it's, we're also programmed where, if people lose 20%, that's a lot more painful than losing 2% a year for 10 years.
Yeah.
It's just how we're designed for loss aversion.
Right.
And so I just think the only way around it is people have to do a lot of research and education to see, okay, what do I want to invest in over, say, a 5-year period? And what is that going to look like in inflation adjusted terms, not just nominal terms?
Bitcoin's BTC early Friday slide, triggered by concerns about crypto-friendly bank Silvergate, SI, shook out bullish leverage from the futures market. Hello and welcome to Money Talks. In today's video, Lyn Alden updates about her outlook for Bitcoin in 2023. She also breaks down the importance of regulatory clarity in the space and how it will drive the future of institutional adoption in crypto.
So I think the person who doesn't want to spend a lot of time should be reasonably diversified, right? Because if they own let's say they all go all in on Bitcoin and Bitcoin has one of those 80% drawdowns, they're going to sell it, right? If they're not deep into the Bitcoin research, that if they haven't done 1,000 hours of research on it, they're going to freak out and panic when it gets cut in half, and then they're going to lose value. So for most people, I think that some degree of diversification makes sense. You want to have your liquidity needs met with cash to some extent. And then, I personally find equity investing, really useful. That can be either individual stocks, or if I had less time, would be ETFs. But then I would want, hard money as a notable part of that portfolio, which in my view today does include Bitcoin. And so I think it really depends on what someone's trying to optimize for. I think you can make a case where it's almost like a barbell approach, and that's this kind of way I'm approaching it, which is I focus on investments that provide pretty good income, and an income that grows with inflation on one hand, and then I also have a slice for say Bitcoin, some gold, things like that are kind of these bare asset alternative monies that have a much slower supply growth rate on average than you're getting with fiat currencies. And the Bitcoin, you have the added kicker that is also, arguably, if the thesis is correct, is arguably under-owned. It's still in its adoption phase. And so in addition to being, a finite asset, it's also basically still underappreciated, understood, and it's kind of growing into whatever total addressable market that it's eventually going to reach.
Exchanges liquidated longs or bullish Bitcoin futures worth over $62 million during the Asian hours, the highest amount since August, according to data from Glassnode. Short liquidations worth just over $500,000 were also observed. Bitcoin, the leading cryptocurrency by market value, fell over 5% to $22,000, reaching the lowest since Feb 14, CoinDesk data show.
On their background, if someone has a computer science background or kind of like a, say, Austrian economics, kind of sound money type of appreciation, one of those two avenues generally will probably help you understand the value proposition quicker than if you're coming at it, from a very different background. But basically, I do think it takes, a couple hundred hours to really get far enough in that you really know what's going on. And the challenge is, so anything that seems to the outside like a speculation can become a lot less of a speculation if you're really knowledgeable on that thing. Like, for example, there are deep value stocks that on the outside, someone will say like, hey, what do you think of this stock? And I look at it and it looks like super risky. And it's like, I'm like, I have no idea. I'd have to spend dozens of hours going into their books. But somebody who has gone into the books and then also researched the industry might end up viewing that as a very low risk investment. They're like, it's super cheap. The market is mispricing X, Y, and Z. And here's kind of the range of outcomes, and almost all of them are favorable at these price levels, and they can develop a thesis for why that makes sense. And so for them, they don't view it as a speculation, even though a market that hasn't spent at least an hour on it does view it as speculation. I think Bitcoin's kind of the same way, because you have to understand money to some extent, which is just not well understood, the topic of money. Two, you have to understand protocols, right? You have to have some understanding of the history of protocols, things like that. You also have to understand some degree of code. Why is this different than Dogecoin, for example, right? The average person would have trouble explaining the difference. That they would just say, well, Dogecoin's kind of like Bitcoin, but it also has dogs, so it's better. And so basically someone has to go into, well, okay, here's why node size matters. Here's why bandwidth matters. Here's why the parameters and the liquidity and the network effect of Bitcoin are different than something like a Dogecoin, right? And so that all of those avenues take time. Then you want to go and investigate the risks. Okay, what have been the bugs in the past? What is a hard fork, and why are there sometimes different factions in the ecosystem that want to take it in different directions? And you kind of go through, you basically should be able to outline all these different avenues. And for a lot of people, when they've done all of that, then they start to view it like a savings technology. But even then, they still have to acknowledge risks. They have to obviously acknowledge volatility and say, okay, this is savings technology for, X% of my net worth that I can afford to have, go down by 80% sometimes, but that I expect to go up long term. And I do think it's just going to take a lot of time, because something like a cell phone, when it comes out, can get adopted very quickly. The problem with getting adopted something monetarily is that there's going to be a lot of leverage placed on it, and you're going to get these bubbles inevitably.
Shares in Silvergate fell 50% on Thursday after the crypto-friendly lender said it's evaluating its ability to continue as a going concern and delayed filing its annual report with the Securities and Exchange Commission. Bitcoin's late reaction to Silverage news perhaps stemmed from fears that the crisis at the bank, known to facilitate fund transfers between exchanges and other market participants, may worsen the liquidity crunch in the crypto market.
First, to touch on your prior point, I do agree that most people will not understand Bitcoin at a deep level, just like they don't understand the current system at a deep level. Most people, for example, if you pay with a credit card, they can't tell you the complex handshaking that's happening between the banks along the way, how many different entities are involved. Just to take the four big credit card networks, Visa, MasterCard, Discover, and American Express, most people don't know the difference. And for example, Visa and MasterCard are not banks. They're just like these technology rails that banks issue cards on, whereas Discover and American Express are banks, and they're also these payment rails, right? And then you have basically acquiring banks. You have there's so many different like handshaking aspects for how that works. Let alone if you go into like repo markets, like basically how's fiat working at the wholesale level, basically between banks and things like that. It's just a very complex market. I remember like there's this crazy diagram that shows how the dollar system works between the Fed and all these things, and it almost looks like a like an Ethereum roadmap, like this crazy, this like this Rube Goldberg machine. And I remember, I think I tweeted something like, this whole dollar thing is like way too complex. Like, give me Bitcoin instead. And it's one of those things like if you had to just learn the dollar system from the root, from scratch, and someone was like trying to sell you this idea, it would take a lot of time to spin up on that. And so I do think basically Bitcoin only has to be understood by the marginal that will then shift over. And then once it hits critical mass, it's just like, well, okay, this other thing's devaluing and this thing's not devaluing. And so it just kind of works itself out over time. On to the prior point. So I don't set out to trade. For Bitcoin, I dollar cost average in. I think that's how the majority of people should consider doing it. Basically, just determine what allocation makes sense to you, and just kind of stick with it and have like say a 5+ year view. Preferably longer, but I know realistically, like a 5-year thesis for what this kind of is playing out. For portfolio management, because I do, I provide a lot of investing research. I focus on this full time, and generally what I'll do is if something is becoming very euphoric or it's become a very oversized allocation in the portfolio, I will generally trim that. And so, when I have, say, securities that are proxies for Bitcoin, maybe they're Bitcoin mining stocks, maybe they're maybe they're MicroStrategy, maybe they're one of the ETFs or trusts that hold Bitcoin. If I'm doing that specifically in a portfolio context, and let's say I have 5% of the portfolio in them, and then they go up to 15% of the portfolio because they've gone exponential in like an 18-month period. What I've done in the past, like during this prior bull run, I said, okay, it's getting euphoric out there. Dogecoin's going vertical. This is tripled in terms of my asset allocation, so I am going to sell into the strength and basically, lock in the gains you've made, because that allows us to then maybe redeploy when now we're like in a bear market. And so I do risk management in that regard, because I do have, a lot of people reading the research and they don't want to be caught off by, massive drawdowns. And, I never try to predict, okay, here's the top, here's the bottom, let's actively trade this. It's more like, depending on if it's euphoric or depressed, if it's way above kind of like, volatility adjusted price bands or below them, I kind of just make note of that. And I say, well, okay, when it's euphoric like this, the probable range of future returns is now diminished over, say, a 2-3 year period. Whereas if it's super cheap, it's okay, now the probable range of future returns is better. And so I do manage the volatility in that sense. But I, for example, I never touch cold storage Bitcoin. That's a different animal.
So what are your thoughts about Lyn Alden's prediction? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.